Hey guys, welcome back to Tango Delta 6. My name is Dave. Today we're going to be talking just a little bit about what are reflections and why would you want them. A lot of people have been asking me for a tutorial or an explanation of reflections. It is a newer concept. It's only a few months old in 2021. So I wanted to get this information out to you and kind of give you my perspective from the Tango Delta 6 side of things as to what the reflections are and why you would need them. So first, let me thank you for being here, and if you get a chance, please like and subscribe to the channel. We're going to do more informative content like this, and we're glad to have you here. I just really appreciate you stopping by, and let's get into it, okay? So what are reflections and why would you want them? So the best way to compare reflections, a lot of people will compare cryptocurrency to the stock market because it's like you buy tokens instead of shares, and it's a very similar concept. So reflections are like dividends. When you buy a stock, if the company that you buy stock in, like Microsoft or Apple or whatever, if they're a profitable company, like 4 times per year, they'll pay out a dividend. So usually quarterly or every 3 months, you'll receive some money back, so to speak, for the money that you have invested in that company. It works the same way in cryptocurrency, where the dividends are paid, but it's more based on tokenomics. And so because they are calculating these on a transactional basis, the pools will fill up. And you'll see that instead of being paid every 3 months, they're typically paid every day. And if a token has a lot of value and a lot of volume being traded, reflections will actually come out on an hourly basis in some cases. So the more trading volume that a token has, the higher the number of times per day those tokens will pay out. This concept appeared in early 2021. So it's not an old concept. It's basically kind of a revamp where they've taken smart contracts inside of a token and made it where they can add this additional benefit. And it's very attractive to own a token that pays in reflection because of the passive residual income stream that it will create. So let's talk a little bit about tokenomics. As you can see on the screen here, basically the tokenomics of a particular token is the rules that the token follows when a buy or sell is executed. When you go look at a website for a token and you pick up their tokenomics tab on the website, they'll usually tell you exactly how these things work out. A lot of the functions that you'll see out there is a tax that is going to be deducted anytime there is a purchase or a sell, like a buy or a sell is going to be taxed a certain percentage, and that percentage gets held off to the side out of that transaction, and then it funds all of the different things that the tax is designed to do. As you can see here, the deduction gets divided up and that money gets distributed out. So primarily here on the top of the list, it's sent to holders. So the reward for holding a token or buying the token and just simply having that token in your wallet is after you own the token, anybody that buys or sells it is going to pay the same tax you did when they get involved in the token or buy or sell the token. And then a percentage of that sell is going to come back to you because you're a holder. We'll explain more about that in a minute and the math of how it works. But there are other things that these tokenomics can do which will add to the health of a project or the longevity of a token, is that you can add some of that money to the liquidity pool. You can also have buyback and burn, which keeps the token healthy, and it allows for the principals of a company or a token can basically buy back or burn a certain percent, which would decrease the supply, which would increase the demand in theory. You also have marketing budgets. So for tokens, a lot of tokens nowadays are launching first and then coming up with their use case second. And the popularity of a reflection token helps them to raise some money. So you might see 1 or 2 or 3% that gets sent back to the marketing budget, that once the token launches in the beginning and starts to earn a lot of money, now the company has a budget, so to speak, of money that came from the tax that was charged to then be able to go out and do things like pay for the press releases or ask people to do YouTube videos and pay them for their content. Another thing you have is funding the use case or project. In a previous previous video, we talked about the J curve and how when a company first launches a token, it usually shoots up in value and then it might retract or consolidate just a little bit. Usually during that time when the trades are going on, buys and sells, buys and sells, buys and sells, the money that's coming into use case budget, a use wallet is what they like to call it, then they'll take that money and develop it. So maybe the company doesn't have an app yet. They're going to work on that app. Well, the money to get that app built is going to come from the use wallet as part of the tax. And then the last thing would be funding the development. So you'll see a dev wallet or something like that. People like to get paid for the work that they do. So when you attract devs to your project, they're going to look and see if your token has a dev wallet or something that can actually put a little money into the kitty so that you can pay your developers to do the work of launching your token for you. When you sell, that also gets taxed, and so in some cases some tokens have a double tax, right? So you might have a simple token that just takes the same percentage on a buy as it does on a sell. In other tokens, they might double the sell tax, and they do that so that basically they're de-incentivizing the sales process. When somebody with a lot of tokens sells a lot of tokens, it hurts the price. So a lot of tokens now, we're starting to see a trend where they're doubling the sell tax. So if you get 5% of tax goes to the holders when somebody buys, it might be 10% tax on a sell, which means if you sell $100 worth, 10% of that would be deducted. So you'd only get $90 worth when you sell. And that would be something to kind of promote you not to sell or to hold it long term. So the next thing we want to talk about in reflections is volume. Now, volume is the key component for how you calculate reflections. And volume is just basically calculated by, on a 24-hour basis, it's a cumulative total of all of the buys and sells for that token in a 24-hour period. So your volume in 24 hours is the key metric that you want to look at when you're calculating reflections. When you add up all these buys and sells, that gives you the total volume. The higher the volume, the more reflections are going to be paid out. The next thing to know about is the holder pool. So the holder pool is basically the total number of people that hold the token, and that's the box. That holder pool is the box where all the reflections go when the buys and sells are taking place. It sits in that box until it reaches a certain threshold. So if a token has really low volume, it might take a long time for it to get to, let's say, $200,000 in that wallet. And if that's their threshold, you have to wait until the token wallet for all of the holders reaches that 200,000 before it's going to send it out. It's actually not a bad thing. If you're new to crypto, you'll notice one of the first things you see in a Discord is, hey, I just bought the token. Where are my reflections? Well, if that token's experiencing slow volume, you may not see it for a while. And also, I'm about to cover, the more shares you hold, the more money you're going to receive when the token pays its reflections out. So the percentage of the volume goes into the pool fills up, and then it's divided evenly amongst all the holders. This is what I like to call buy early and buy big, right? So the key to getting massive number of reflections is to hold the highest percentage of a token that you can get your hands on. Typically, if you get late to a token, like you're showing up 6, 8, 10 months down the road after it's already been open and started, it's going to take you a lot longer to build up a massive bag within that token because the price has already gone way up. So if you put $100 into that token, you divide that by the price per share, and that's how many tokens you get. Well, if that token is at $1 per share, let's just use that as an example. If you put $100 in, you'd get 100 shares. But if that token is at 1 penny per share, you'd put that $100 in, you get thousands of shares. So the differential between the two is that being earlier into a token is typically the best concept, because the earlier you get in, the lower the price, the more tokens you can buy with the same amount of money that you're putting in. This is all public. You can go on to bscscan.com. You can pull up your favorite token that you want to see an example for, and you can see the wallets on the holders tab of who owns what. Now, you can't tell who they are. It's just a bunch of random addresses, but you can see an example of how the token is set up and how many people own it. Like, for instance, in this case, there are 3 people actually two people, because one is a liquidity pool. There are two people that own 2% of this token. There are a lot of people that own 1%, and then as you scroll down, you'll see the bags get smaller and smaller and smaller. So when you look at the holder count here, you can see like this particular bag in position 3 owns 2.1% of the token, and currently that bag, as of the time that I took this screenshot, was worth about $2.8 million. So that gives you an idea. The person who holds that bag holds 2% of the Nobility token. So that person, when Nobility sends out their reflections, will receive 2% of that pool. Now, this person could have gotten in really early, or they could have put in a whole lot of money to purchase basically that high number of percentage. But as you know, as tokens get older, the price keeps going up. So it gets harder and harder and harder to get into that 2, 3, 4, top 10, top 50 spot. If you know how this works, then you'll start to understand that that pool is a fixed amount, so to speak. I mean, the volume fills it up at whatever rate, but then it gets distributed at a fixed amount. So the more tokens you hold, the more reflections you'll get. If you're late to a token and you only, let's say these guys have billions of tokens and you have 100 tokens, you may not even get reflections right away, because the reflections might be so small that it would cost more in gas to send it out than it would to actually pay it. So it'll sit there and accumulate until it can be sent to you without costing you more gas and just eating your reflections up. So knowing that the pool is evenly divided, let's take a look at this example. If you own 2% of a token and that token sends out $100 in total reflections for the day, you would receive $2. If that same token sends out 100,000 per day, then your 2% would get you $2,000 for that day. So now you understand you want to have the largest number of shares that you possibly can. And the way to look and see where you stand in the pool is to go to the holders page on the BSC website and just see scroll down till you find your bag, your wallet address, and then see what your percentage is. Then you can go back and look at the volume, multiply the volume times your percentage, and that's going to be about what you can receive that day. But the key takeaway on this slide is that the volume is important, but the size of the bag is even more important for the long term. So let's talk a little bit about how that promotes itself into a different concept, right? The key is not just buy early, but it's buy more. So if you want to get a massive reflection coming, you don't want to hold just one token and have a massive position. You want to have as many tokens as you possibly can, but by buying them early, getting them right after they launch, right before they launch, within the first week of launch, or you watch it when it launches and you wait for it to come back into consolidation. You buy it after the initial pump and dump is over, right? There's many ways to time this, but the key is to get in early while the price is low so that you can buy more tokens. This example on this screen is going to blow your mind. I know it did me. Just preparing it edified the idea that I'm putting down and seeing it on paper. I mean, math is math, guys. Numbers don't lie. It's not your friend. You can't change 2 times 2 and make it into 5. It's just always going to be 4. So diversity is one of the things that you get by holding multiple tokens, right? And diversity provides security and reduces your risk. If all of your tokens are in one bag and something happens to that token, you could be in a world of hurt, because you could lose all that value, especially if you spent weeks and weeks and weeks and weeks buying up and buying up to build the size of your bag. I'm not saying that's a bad thing. People get involved with projects, they fall in love with them, the communities are great, you want to be a part of it, but you have to think into a bigger picture, because ultimately the purpose here and what we're helping with Tango Crypto, we want to help you build a portfolio that is insulated against risk, but also provides you with a passive residual income, which means you can go to sleep and wake up and have more money than you went to sleep with, and that's happening automatically, okay? So you can build your wealth exponentially by diversifying into multiple tokens. So let's talk about one versus many. Traditionally, people think it's okay just to buy that one token, and it is. It is okay to be in a huge position in one token. If you love that token, it's got a great use case, you think it's going to be here 20 years from now, you can go ham on it. Just go crazy. Buy as many as you can. That's great. But let's look at this example on the screen. Let's just say that the one token that you hold is you just keep on buying and building and building and building and building. That token gets up to daily volume of 5 million in sales, and the reflection rate is 7% into the pool. So the total reflections for that day going into the pool would be 350,000. But because you started late, or maybe you weren't in the very beginning on that token, you've worked really hard, but the size of your bag is 0.01% of the total pool. Your daily earnings off of those reflections that everybody is getting would be about $35. Now let's just use the same example across many tokens, but we get in early to all the tokens that we are getting into, right? Early is always better. Watch this. It costs less to buy more tokens in the beginning when the price is low. You get more shares for the same amount of dollars that you are putting into the token, and it's going to pay you exponential long-term gains. So in my example here, I chose one token doing $5 million in volume per day versus 5 tokens that do $1 million per day. Now that's the same amount of volume, but it's spread out amongst 5 tokens. It's 1/5 of the actual work that the main big token that we talk about was doing, but it's spread out. It's much easier for a bunch of tokens to get to 1 million than it is for one token to get to 5 million. They got to have a really good use. There's got to be really good play involved to it. You know, it's a lot more work, and these are just numbers, but you could change this to 5 billion versus 1 billion or whatever. I mean, you got to know what your token is capable of by looking at the different components involved. But in this example, let's take a look here. 1 million a day across 5 tokens that all pay 7%. So they're identical to the first example, but they're just smaller tokens, but you got in earlier. The reflection pools are smaller because 1 million times 7% is $70,000. But if you look at this, let's say you have a 1% bag that you hold as a proportion of the entire pool in these younger tokens because you bought it on day 1, or you bought it on day 2, or you got into the pre-launch and you bought a lot of tokens. Now you have a 1% stake in each one of these 5 versus a 0.01% stake in the big token that's been out for a little while. The daily earnings on each one of these tokens would be $700, which would total up to $3,500 for the same amount of volume in the same 24 hours, but you divided it out amongst 5 tokens versus the one token doing 5 times the volume. So this is where I came up with the idea of my 1x, 4x, 1x philosophy that I talk about in a previous video. Basically, you put a little bit of money into a token, you get in early, so it's easier to get it to like a 4x multiplier. Once you take out your 1x, the 3x that you leave in the token is just an equity piece to just sit there. You could literally just leave that investment there forever. You wouldn't even have to look at the charts every single day, because in your mind you're relaxed because that one token can't make or break your portfolio. You took the 1x out, you're already looking at whatever token's going to come out tomorrow, right? Now you're diversifying. Now your goal over a week, a month, a year, 2 years is to just keep doing this over and over and over and over until you have so many tokens. Yeah, maybe you got in a little early. Maybe some of them don't do too well. That happens. We've all had tokens that we lose our value in. But the reality is, just on this example, if you had 5 tokens with 1% versus one token that does 5 times the volume, but you have a smaller percentage, you could earn 10 times as much money across those smaller tokens. Imagine if you had 100 tokens doing $1 million a day. That's $100 million a day. If you took the average percentage that you own of each one of all those and aggregate it, there's your income for the day. You could be making 1,000 a day, 10,000 a day, 20,000 a day. It might take you a year to build that position, but you'll get there. We talk about this every day in Tango Crypto, and really the goal of what we do is we're trying to get better by sharpening each other, and we're trying to help each other out by developing these concepts. And also we talk about the tokens every single day. So we're excited that, at the time of this video is being released, we're actually looking at opening up our Discord this weekend. So if you're interested in joining the Tango Crypto educational channel on Discord, it's going to be publicly released this weekend. So you can follow me on on Twitter at Tango Delta 6. You can send me a direct message. You can ask me questions about my videos. If you have a concept that you want me to do a video on, I'd be happy to put it together for you. And also, you can look for the hashtag Tango Crypto anywhere on any of social media platforms, and that'll draw you back to not only myself, but some of the phenomenal founding members that are a part of this wonderful organization that we're putting together to try to help you get better at learning how to do cryptocurrency. So I just want to thank you for stopping by and watching the video today. Please, if you like the content, like the video, please feel free to share it out on your social media. If you have somebody that you know is interested in getting into crypto, maybe they want to learn, they want to find a safe space, they can reach out and become a part of our group, and we can help get them started in crypto. We don't give financial advice. Nothing we talk about is financial advice. We're not advisors. We're not brokers. What we are is concerned people that love to do what we do. We're getting better at it every day because we do it all day long. And then we're just wanting to turn around and share that information back to you guys so you can become better as well. So thanks for coming in for Tango Delta 6. This is Dave. I hope you guys have a great day, and we'll see you in the next video. Bye-bye.